Learn to Earn, A Beginner's Guide to the Basics of Investing and Business by Peter Lynch and John Rothschild. Picture two young people, both around your age. We'll call them Joe and Sally. They're living at home with their parents, and they've just landed their first real jobs at the local Walmart. The excitement is real. They're finally earning their own money. Joe has his eyes on something specific. There's this gorgeous new Camaro sitting in a showroom, practically glowing under the lights. It's sleek, it's fast, and he's completely mesmerized. He scrapes together every dollar he can save, throws down $2,000 as a down payment, and commits to a 5-year car loan. Those first few months feel amazing. He's cruising down the street feeling like a champion. But pretty soon, that new car smell disappears. A few dings show up on the door. And month after month, $400 just vanishes from his account, heading straight to the finance company. 5 years later, he's shelled out $26,000 for a car that's now worth maybe $5,000. He's tired of it, and financially, he's right back where he started. Now Sally's story takes a different turn. She works right alongside Joe at that same Walmart. She also manages to save $2,000. But instead of going for the flashy new ride, she picks up a reliable used Ford Escort and pays cash. Sure, it's not turning any heads, but it gets her wherever she needs to go. Here's the key difference. Without a car payment hanging over her head, Sally takes that same $400 Joe's sending to the bank and puts it to work. She invests it in a stock mutual fund. Fast forward 5 years, Joe makes his last car payment and finds himself with nothing but a car he's grown to resent. Sally, her investment has been quietly multiplying, compounding, building on itself. After those same 5 years, her mutual fund is sitting at nearly $30,000. That's enough for a solid down payment on her own house. This story isn't really about transportation choices. It's about something much bigger, a fundamental decision we all face at some point. It's the choice between simply consuming things and actually owning things. And that's the heart of one of the most practical and approachable books ever written about money, Learn to Earn, by the investing legend Peter Lynch. Peter Lynch is kind of a big deal in the investment world. When he ran the Fidelity Magellan Fund, he transformed what started as a modest fund into a $14 billion powerhouse, with average annual returns above 29% for 13 straight years. That's the kind of track record people still talk about decades later. But here's what makes Lynch special. It's not just that he knows how to pick winning stocks. It's that he can explain the whole world of business and investing in a way that makes sense to anyone, no matter their background. He wrote this book because he noticed something troubling. Schools almost never teach the most practical subject of all, how money, business, and investing actually work in the real world. So here's what I want to do. I'm going to walk you through his wisdom in a way that hopefully clicks for you. My goal is simple. By the time we're done here, you won't just see the world as a collection of stores and products anymore. You'll start seeing it the way an investor does, as a landscape full of possibilities, where your money doesn't just disappear when you spend it, but can actually work for you and grow. You'll understand how this whole system came to be, and more importantly, how you can be part of it. Let's start with your morning. Today, in fact. From the second you opened your eyes, you've been surrounded by something you probably didn't even notice. You've been moving through a world that's been built, owned, and run by thousands of companies you've never thought about. That clock radio that pulled you out of sleep might be from General Electric. The sheets you kicked off could be from a company called West Point Stevens. The toilet, the sink, that faucet you use to brush your teeth, possibly American Standard. Your toothpaste and shampoo? There's a good chance they're from Procter & Gamble. The razor? Gillette. The underwear? Fruit of the Loom. You haven't even made it to breakfast, and you've already interacted with half a dozen public companies. At the breakfast table, those Cheerios are from General Mills. Pop-Tarts? That's Kellogg's. The orange juice might be Tropicana, which belongs to PepsiCo. These companies are woven into every corner of your daily routine. The bus taking you to school was probably built by General Motors, rolling on Goodyear tires, burning gas from Exxon or Texaco. Even those textbooks in your backpack come from publishers like Simon & Schuster or McGraw-Hill. Almost everything you touch, eat, wear, or use is made by a public company. And here's Peter Lynch's first big idea. A public company is actually one of the most democratic things in existence. What does that mean exactly? Well, imagine you love your neighborhood barbershop or this amazing family restaurant down the street. You can't just walk in and say, "I'd like to own a piece of this place." That's a private business. But if you're impressed by how Hilton hotels operate, or you notice crowds lining up for the latest iPhone, or you just really love your Nike sneakers, you can actually become an owner. When a company sells shares of itself on the stock market, it becomes public. And that means anyone, literally anyone, can buy in. Your age doesn't matter. Your background doesn't matter. Where you come from doesn't matter. If you've got enough money for even a single share, you can own a piece of Nike or Apple or McDonald's. The CEO can't tell you no. That's equal opportunity in its purest form. When you buy stock, you're buying a real piece of that business. That share certificate, or these days, that entry in your brokerage account, represents actual ownership. It has genuine value. When the company does well, when it sells more products and increases its profits, your little piece becomes more valuable. The success flows back to you in a very real way. This is the foundation of what we call capitalism. It's a word that gets tossed around carelessly sometimes, often with negative associations. But at its core, Lynch shows us, it's actually a pretty elegant system. Investors like you and me provide the money, the capital, that helps companies grow. The company uses that money to build factories, open stores, create products. That creates jobs. More jobs mean more people earning money to spend, and some of that money gets saved and invested, which starts the beautiful cycle all over again. Investors are the spark that lights the whole thing up. But how did we end up here? How did this world of corporations and stock markets come into being? This isn't just dusty history. It's actually the story of a revolutionary idea that changed everything. For most of human existence, regular people owned nothing. They worked as serfs or slaves for kings and nobles who owned all the land and all the wealth. There were no paychecks because there was nowhere to spend money. The concept of moving up in life literally didn't exist. You were born into your station, and that's where you stayed. The first real shift started in an unexpected place, on a bridge over the Amstel River in Amsterdam. Way back in 1602, ordinary Dutch people were gathering on this bridge, jostling and competing to buy something revolutionary: shares in a company called the United Dutch East India Company. This was the world's first popular stock, traded on the world's first stock exchange. The company took the investors' money to outfit ships that sailed to Asia, bringing back spices and exotic goods that Europeans couldn't get enough of. The company thrived. The stock price doubled, and shareholders received regular payments called dividends. Capitalism had officially arrived. This concept, pooling money from many people to fund big ventures, is what made exploring the New World possible. History books focus on the brave explorers and settlers, but they often skip the most important detail. Someone had to pay for those ships. When the Pilgrims arrived at Plymouth Rock, they were actually landing on property owned by an English company. Their entire voyage was bankrolled by a group of London investors who called themselves the Adventurers. These investors struck a deal with the Pilgrims. "We'll finance your trip to America, and you work for 7 years to make the colony profitable. At the end, we split the profits." The story gets interesting. The investors got greedy at the last minute and changed the deal, demanding the Pilgrims work 6 days a week instead of 4. Feeling betrayed, the Pilgrims set sail without a signed contract. Their first ship, the Speedwell, started leaking and had to turn back. They all crammed onto the smaller, slower Mayflower and got blown off course, ending up in Massachusetts instead of Virginia. From a business standpoint, Plymouth Colony was a complete disaster. It lost money year after year. The London investors were livid. They weren't seeing any return on their investment. Finally, in 1627, the frustrated investors sold the whole operation to the Pilgrims themselves for £1,800 British. which the Pilgrims had to pay back over time. This was actually America's first leveraged buyout, workers taking over the company with borrowed money. The Pilgrims' story teaches us something fundamental about human nature. At first, they tried a communal system. Everything was shared, and nobody was allowed private property. Governor William Bradford quickly realized this wouldn't work. Why would it? Someone who worked hard got the same rewards as someone who barely lifted a finger. He understood that when people own something personally, when they have real skin in the game, they work infinitely harder. So they switched systems, allowing people to own their farms and boats and profit from their own efforts. That free enterprise approach is the foundation of what we have today. The idea of selling shares to the public caught on slowly, and sometimes spectacularly crashed. In the early 1700s, investment bubbles formed and exploded. In France, a smooth-talking con artist named John Law launched the Mississippi Company, convincing everyone that Louisiana was overflowing with gold. Parisians went crazy, throwing their life savings at the stock. The price skyrocketed to absurd levels before collapsing completely, destroying fortunes and crippling the French economy. London saw something similar with the South Sea Company. The stock market got such a terrible reputation that Parliament actually banned buying and selling shares. But the idea was too powerful to stay buried. In America, after the Revolution, financial pioneers like Alexander Hamilton understood that for the new nation to grow, it needed banks and a financial system. Companies formed to build bridges and roads, funded by selling shares to regular people. These became the ancestors of the massive railroad, canal, and industrial companies that would transform the country. The 19th century was America's age of invention: the steamboat, the cotton gin, the mechanical reaper. But here's the thing. These inventions would have just sat on paper without capitalism. It took investors willing to risk their money to build the factories that manufactured these revolutionary machines. This brings us to another crucial concept: the invisible hand, an idea from the great economist Adam Smith. Smith argued that when millions of people are free to pursue their own work, to make and sell what they want, society as a whole benefits enormously. You don't need a king or government bureaucrat dictating what everyone should do. The market figures it out naturally. If too many people start making hats, the market floods with hats, and prices drop. Some hat makers will then switch to something more profitable, like growing vegetables. This invisible hand keeps supply and demand balanced automatically. This competition is incredibly beneficial for consumers. It forces companies to constantly improve products and lower prices. That's why every few months, computers get more powerful and cheaper at the same time. As America expanded, so did its companies. National brands we still recognize today emerged: Campbell's Soup, Heinz Ketchup, Wrigley's Gum, Levi's Jeans. Alongside them rose powerful, sometimes ruthless industrialists, known as the robber barons, men like Andrew Carnegie, Cornelius Vanderbilt, and John D. Rockefeller. They built massive empires in steel, railroads, and oil. This led to one of capitalism's greatest dangers: monopoly. A monopoly exists when one company or a small group controls an entire industry. Think about the board game Monopoly. The goal is owning everything so you can charge whatever you want. In real life, monopolies work the same way. If one company controls all the oil, it can set prices wherever it wants, and customers have zero choice. Competition, the lifeblood of capitalism, was being strangled. Rockefeller created the Standard Oil Trust, which controlled 90% of America's oil refineries. Similar trusts formed around sugar, whiskey, and tobacco. It was frightening. Economic freedom seemed to be slipping away to a handful of powerful insiders. But Americans pushed back. Investigative journalists called muckrakers exposed the abuses. Bold political leaders like President Teddy Roosevelt became trustbusters, using new antitrust laws to break up these giant monopolies. Standard Oil was split into smaller competing companies we now know as Exxon, Chevron, and Mobil. Decades later, the same thing happened to AT&T, the telephone monopoly. Breaking it up created more competition and cheaper phone service for everyone. This is the system correcting itself, preserving the competition that keeps it healthy. So this grand, messy, ultimately triumphant story brings us to today. A world with thousands of public companies, regulated markets, and the opportunity for anyone to become an owner. Now you might be thinking, this history stuff is interesting, but how do I actually make money? And this is where we shift from past to future. Lynch's most urgent advice is beautifully simple: start now. The single greatest advantage any investor can have isn't a genius-level IQ, isn't an expensive education, isn't even a lot of money. It's time. Let's look at Chris and Pat, two people from an example in the book. Chris starts investing early, at 18, with just a $2,000 initial investment. He keeps adding money regularly from his income. Pat waits until he's 40 to start investing. Even though Pat invests much larger amounts each year, more than double what Chris puts in, by age 65, they both end up with the same amount, just over $900,000. How is that even possible? The magic of compounding. When your money earns returns, those returns start earning their own returns. It's like a snowball rolling downhill, gathering more snow as it goes. The longer it rolls, the bigger it gets. Chris gave his snowball a 22-year head start. That head start was so powerful that Pat, even by adding way more money later, could never catch up. We should really change the saying from time is money to time makes money. So where should you put the money you're saving? Lynch walks us through 5 basic options. First, there are savings accounts, money market funds, and certificates of deposit. These are safe. Your money is usually insured. But the downside is they pay very low interest. Often the interest doesn't even keep up with inflation. Inflation is just a fancy term for prices rising over time. If you're earning 2% interest but prices are climbing by 3%, you're actually losing buying power. Your money is on a treadmill that's slowly moving backward. Second, there are collectibles, things like stamps, coins, or baseball cards. This requires specialized knowledge. You need to be an expert. Plus, collectibles can be lost, stolen, or damaged. And here's an important lesson. Buying a new car is definitely not an investment. It loses value the second you drive it away. Third, there's buying a house. For most people, this ends up being their best investment. You can live in it, and you typically buy it with borrowed money from a bank, which can multiply your returns. Fourth, there are bonds. When you buy a bond, you're not an owner, you're a lender. You're loaning your money to a company or government for a set period, and they promise to pay you fixed interest. Bonds are safer than stocks. If you buy a McDonald's bond, the company is legally required to pay you back. But there's a trade-off. If McDonald's has an amazing year, the stockholders will see their shares jump in value. The bondholders? They just get their regular interest, nothing more. Over long periods, bonds have provided much lower returns than stocks. This brings us to the 5th option, and in Lynch's view, the best for long-term growth: stocks. When you buy stock, you're buying a piece of a real business. If the company succeeds, you share in that success. History is crystal clear on this. Over many decades, stocks have outperformed every other type of investment. But what about the risk? What about market crashes? This fear keeps countless people away from investing. The ghost of the 1929 crash still haunts our collective memory. Lynch addresses this fear directly. Yes, the market has corrections, drops of 10% or more. It also has bigger drops called bear markets. These are unavoidable. Over a 50-year investing life, you can expect to live through 8 or 9 of them. The critical mistake people make is trying to predict these downturns. They sell their stocks, hoping to dodge the crash, then wait for things to settle before getting back in. Lynch says that far more money has been lost by investors trying to anticipate corrections than has been lost in the corrections themselves. Why? Because the market's best days often cluster right near its worst days. During one 5-year stretch in the 1980s, the stock market gained an incredible 26% annually. But most of those gains happened on just 40 days out of over 1,200 trading days. If you missed those 40 crucial days, your return dropped from 26% to a measly 4%. You would have done better in a savings account. The lesson is clear: you can't time the market. The real secret is investing for the long haul and staying invested. Your discipline, your patience, your courage to hold on during the rough patches, these matter more than your intelligence. So how do you actually get started? Lynch presents two paths. The first, and easiest for beginners, is through mutual funds. A mutual fund is a simple but brilliant concept. A fund manager collects money from thousands of investors, large and small, and invests that pool in dozens or even hundreds of different companies. When you invest in a mutual fund, you automatically become a part owner of all those companies. This is much less risky than putting everything into one stock. You can often start with as little as $100 and add more whenever you can. Lynch offers some timeless guidance on picking funds. If you're investing for the long term, skip the bond funds and go for pure stock funds. Look for funds with long, consistent track records of success. And consider something called an index fund. An index fund doesn't try to beat the market. It simply buys all the stocks in a particular index, like the S&P 500. It runs on autopilot with very low fees. Over time, index funds have outperformed most actively managed funds, where highly paid managers try and often fail to beat the average. The second path is more adventurous: picking your own stocks. This requires more work, but it can be incredibly rewarding both financially and intellectually. This is where Lynch's most famous principle shines. Invest in what you know. This is your edge as an amateur investor. The Wall Street professionals, with all their computers and fancy degrees, can sometimes miss the obvious, but you have first-hand knowledge from your actual life. Do you work at a mall store? You've got a front row seat. You can see which stores are packed and which are empty. You can observe which ones have enthusiastic employees and customers who love the products. Employees at the Gap or McDonald's could have spotted how successful those businesses were becoming long before Wall Street caught on. Your experience as a consumer is a powerful research tool. Did you just buy something you absolutely love, something that seems better than everything else out there? Find out who makes it. Is it a public company? That's where your research begins. But a great product alone isn't enough. You need to understand the company's story. The story tells you what's happening inside the company that will generate profits down the road. Is the company growing its earnings? Earnings are the profits left after all expenses are paid. Over time, a company's stock price always follows its earnings. If earnings rise, the stock price eventually follows. If earnings fall, so does the stock price. It's that straightforward. Lynch gives a fantastic example with Nike in the late 1980s. The company hit a rough patch. Sales and earnings were dropping. The stock price fell. But if you were a shareholder reading the quarterly reports the company sent you, you would have noticed something change. In the fourth quarter report of 1987, the tide was turning, sales were picking up, future orders were climbing, earnings were improving. The story was getting better. Just as this good news emerged, the stock market crashed in October 1987. Panic spread everywhere. People who confused stock price with the actual business story sold everything, including Nike. But an investor who was following the company's story would have seen this as a golden opportunity. The company was getting stronger, but the crash had made the stock cheap. You could buy more shares at bargain prices. Those who did were rewarded handsomely. Over the next 5 years, Nike's stock became a 12-bagger, meaning it went up 12 times in value. This brings us to the life cycle of a company. Lynch beautifully describes businesses as having life stages, just like humans. It starts with birth, an idea, often born in a garage. Think of Steve Jobs and Steve Wozniak building the first Apple computer. In those early days, money comes from the founders themselves, or maybe from a wealthy friend, an angel investor. As the company grows, it needs more capital and turns to venture capitalists. Then comes the big moment, the initial public offering, or IPO. The company sells shares to the public for the first time. Now it has the resources to reach its full potential. Next is the company's youth. It's energetic and growing rapidly. This is where you might find those explosive 10-baggers. But it's also a risky stage. Many young companies don't survive. Then comes middle age. The company is more stable and reliable, but growth slows down. It might even have a midlife crisis where it needs to reinvent itself to stay competitive, like Apple did in the 1980s facing competition from IBM. Finally, there's old age. Companies like U.S. Steel or General Motors have their best growth years behind them. They might still be profitable and pay dividends, but they're not the spectacular performers they once were. Lynch reminds us that no company stays on top forever. Being a blue chip doesn't protect a company whose time has passed. Throughout this life cycle, companies constantly interact. Sometimes one company buys another. This is called a takeover or merger. Philip Morris, the cigarette company, bought Kraft to expand into the cheese business. This is how industries consolidate and evolve. The business world is a dynamic, living ecosystem, and in this ecosystem there are heroes. Lynch believes we don't celebrate business heroes nearly enough. We worship athletes and movie stars, but what about the people who build companies that create thousands of jobs and invent products that improve our lives? Lee Iacocca saved Chrysler from bankruptcy, protecting jobs for over 100,000 workers and hundreds of thousands more at supplier companies. Fred Smith got a mediocre grade on a college paper outlining his idea, then went on to create Federal Express, revolutionizing package delivery. Bill Gates and Paul Allen, both college dropouts, started Microsoft in a garage and created software that powers most of the world's computers. Bernard Marcus and Arthur Blank got fired from a hardware store, so they started their own and called it Home Depot. Ben Cohen and Jerry Greenfield, two free-spirited guys, took a $5 mail-order course on making ice cream and built Ben & Jerry's. These stories aren't ancient history. Every year, new companies are born, and new heroes emerge. America, Lynch emphasizes, remains a land of opportunity, where smart, hard-working people from modest backgrounds can build something extraordinary. And here's the best part. You don't have to be one of these heroes to benefit from their success. You just need to be a shareholder. You can own a piece of their dreams. As we step back and look at the world Peter Lynch has revealed to us, what strikes me most is its profound optimism and radical simplicity. In a field that often seems designed to intimidate, filled with jargon and complicated charts, Lynch throws open the doors and says, "Come on in. You belong here. You can do this." The most powerful lesson in Learn to Earn isn't some secret formula for picking stocks. It's a shift in perspective. It's realizing that you're already an expert in your own life. Every day, you're surrounded by businesses. You interact with them, use their products, see what works and what doesn't. That personal experience isn't trivial. It's a powerful source of investment ideas. Lynch empowers individuals. He tells you to trust your own common sense over the hot tips and noise from Wall Street. This book offers a beautiful counter-narrative to the idea that capitalism is a rigged game for the rich. Lynch shows it as a dynamic, democratic system where anyone, with a bit of savings and a lot of patience, can become an owner. He celebrates the creators, the builders, the entrepreneurs, who take ideas from garages to global enterprises, creating jobs and prosperity along the way. He reminds us that profit isn't a dirty word. It's the fuel for growth and innovation. So what can you do with this knowledge right now? Let me offer a few simple, practical steps. First, start seeing the world through an investor's lens. Next time you're at the mall, the grocery store, or browsing online, pay attention. What products do you love? Which stores are always busy? Start making a list. This is the beginning of your research. Second, create a paper portfolio. You don't need real money to start. Just take an imaginary $10,000 and pick 5 companies you know and like. Write down their stock prices. Follow them for a few months, in the business section or online. See how they perform. This is your flight simulator. You can learn from mistakes without risking actual money. Third, have a conversation. Talk to your parents or a trusted adult about what you've learned. Ask them about their experiences with saving and investing. Maybe explore opening a custodial account, where they can help you invest a small amount from a part-time job or birthday money. The journey of 1,000 miles begins with a single step. This book is that first step. It's a map and compass for a world that might seem foreign, but is actually all around you. It's a world of opportunity, waiting for you to claim your stake. That was a summary of Learn to Earn by Peter Lynch and John Rothschild. We've covered the big ideas today, but I'll be honest, a summary is like looking at a photograph of the Grand Canyon. Reading a book like this is standing on the edge yourself. The real magic happens in those quiet moments of reading, when a particular story or simple phrase connects with your life in unexpected ways. This summary is a starting point, a way for you to decide if this journey is right for you. If anything we've talked about today has sparked your curiosity, I encourage you to grab a copy. Reading it isn't just about learning. It's an experience that can genuinely change how you see the world and your place in it. You can find a link to the book in the description below. Also, if you found this summary valuable, please take a moment to like this video and subscribe to the channel. It helps me know this work is helping you and ensures you won't miss our next exploration of another life-changing book. Let's keep learning and growing together.